Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 359 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including market rotation year to date, dot-com bubble versus AI today, S&P earnings estimates, interest rate expectations, and an update on the semiconductor sector. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. This week, my guest host with me, Aaron Kramer. Welcome.
Thanks, Matt. Happy to be here. It should be a good one.
It should be a good one. And the listeners and viewers will have to excuse my voice this week. Sinuses are hitting hard.
Allergy season is always upon us.
They are. And we're also blessed on the podcast to have Taylor Ledbetter. She'll be handling our financial planning topic of the week that I know you'll do with her, Aaron, and that'll be a fan favorite as well.
Perfect.
You want to handle pricing, my friend?
So as always, we're going to review the month-to-date and year-to-date performance of the major indices that investors track. This data is from stockcharts.com as of the market close on July 15th. So starting off with the S&P 500 is up year-to-date 10.62% and quarter-to-date, I should have said that earlier, quarter-to-date 0.97%. The NASDAQ Composite Index is up a strong 13.02% year-to-date and quarter-to-date up 0.21%. The IWM Small Caps ETF is up 20.65% year-to-date and down slightly at 1.56% quarter-to-date. The Vanguard All World X United States is up 13.71% year-to-date and down 0.74% quarter-to-date. Lastly, with the Treasuries, the 3-month T-bill is sitting at 3.78%. The 2-year T-bill is sitting at 4.17%, and the 10-year T-bill is at 4.59%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
So a lot of strength in smalls is what jumps out at the page to me.
Huge outperformance year to date, and I believe it's still just a sector that's under-allocated to, underloved by a lot of Wall Street, and obviously it's showing its strength. I love that.
Absolutely. I know you got a good piece on that.
I do have a good piece on that.
All right. Are you right if I jump into big headlines / current events?
Yeah, it's a big headline this week.
Very strong.
Everyone's talking about.
Yeah, and it'll flow right into a topic I have here, which is perfect. So the biggest thing is total CPI or Consumer Price Index was down 0.4% month over month in June, and that's from briefing.com. Consensus is negative 0.1%
That's
lower.
a huge blowout.
It's much lower than expected. So huge surprise, lower for inflation.
Largest 1-month drop since April 2020.
That's great. So that move was paced by a 5.7% decline in the index for energy. So really, I think the Iran conflict having that brief intermission, let's call it.
That's a good way of saying it.
Caused that oil prices obviously to come down significantly. We saw that at the gas pump briefly.
Yeah.
We'll see if it ticks back up here, that conflict resuming. So core CPI, which excludes food and energy, was unchanged month over month. And the consensus was it would be up 0.2% from briefing.com, leaving it up 2.6% year over year versus 2.9% in May. So total CPI was up 3.5% year over year versus 4.2% in May. So that's a big drop. It's encouraging. So we'll see what the Fed does with rates here coming up soon. The key takeaway from the report is the softening in core inflation and the added softening in supercore inflation, which excludes food, energy, and shelter. That component was up just 2.1% year over year. Inflation has not been slayed, but this report should be enough to keep the FOMC at hold at its July 28th, 29th meeting.
I don't want to steal anything you might talk about.
No, it's okay.
Are you going to talk about interest rates at all on your pieces?
I got it.
Well, I'll save my comments for that.
Right,
How about that?
Perfect. Sounds great.
So I'll jump right into tweets, articles, and research for the week. Aaron, the first piece that caught my eye for our listeners and viewers has to do with diversification. So Jenna will put up this illustration for our YouTube viewers. This will be in our show notes. And as a reminder for our newer listeners, all of our show notes are listed on our social media sites. So for Jessup Wealth Management, whether it's LinkedIn, Facebook, X, Instagram, etc., that's where our show notes will be. This chart with the data source, Aaron, is from Creative Planning, Charlie Bolello, and it's titled Diversification Matters, 2026 Year-to-Date Total Returns. And it's going to be through the end of the second quarter, June 30th, Aaron. And I'm going to verbalize this chart for our traditional podcast listeners.
Sure.
So what it's showing is different, I'm going to call them asset classes and performance year to date.
Asset allocation, right?
Right?
Absolutely.
So here's what we're going to do. We're going to start with the underperformers first. Okay? I'm going to go in reverse.
Reverse order here.
So year to date through the, I did not articulate that correctly. Through the end of the second quarter, the U.S. Magnificent Seven, that's going to be names like Apple and Amazon, Meta,
Tesla,
NVIDIA, down 2.5% negative for the first 2 quarters of the year.
Surprising.
Then you have the U.S. large cap growth stocks represented by the ETF IWF, not a recommendation for or against. That was up 5.1% for the first half of the year.
A little bit better.
Then we have the regular S&P 500 represented by the ETF SPY. Again, not a recommendation for or against any of these others I'll mention. Up 10.1% for the first half of the year. Then we have VXUS international stocks up 14% even. U.S. large cap value.
Surprising.
Very surprising.
Value's not really been in the headlines very much with semis being so strong.
Well said. Up 16.
It's kind of up sneakily.
That's a good way to say it. It's under the surface.
It's under the radar, but we've seen some strength there.
You're not going to a cocktail party saying I'm overweight U.S. Large value.
That's boring. That's very boring.
Yeah. You'd be like, that guy's going to be a dud at the party.
Hey, there's the perma value people though.
I'm going to try it at a party and see what happens. So the next thing I got is MDY U.S. mid-cap stocks, 17.2.
Very
You
strong.
kind of highlighted that a little bit with smalls. We'll get to that.
Yep.
U.S. small-cap stocks, IWM, through the first half, 22.6, Aaron.
Excellent.
And then to round it out, IEMG, represented by the emerging market stocks, 24.2. So
if that's not risk on, I don't know what is.
Yeah, that's also a very valid statement. And I brought this up because so many investors are overweight just to large cap U.S. or the Magnificent Seven, and they might be sitting year to date looking at their accounts and saying, I'm up, mid-single digits. Not a bad start to the year.
No.
But there's a lot of asset classes that I feel are not being allocated to by a lot of investors. Then they could be doing a lot better.
Absolutely.
And I
there's
think
definitely been some opportunities out there.
And I think what's happened is the Mag 7's become so much of a one-trick pony.
It's been so good the last, decade?
Right.
That you might as well have owned them.
Right.
So, but when you're overweight those and you don't make any changes or rotation, you miss out on some years.
And it becomes the tail that wags the dog in the portfolio, right?
Exactly.
I'm going to take a sip of my coffee. The next thing I got has to do with .com bubble versus AI today.
All right. I'm ready for it.
All right, this piece I saw was from Mike Zaccardi, and Mike posted this, and what it has to do, and I've been doing a lot of these analogies on the podcast, because, Aaron, I feel the narrative.
There's so much comparison.
Okay? And for someone who actually lived through the end of that.
That's when you started in the industry, right?
I started in the industry. I mean, Aaron, these companies, there was no PEs. They weren't making any money.
No. Yeah, that's the biggest difference I always reiterate to clients is, there's I'm going to pick on a few names, not a recommendation for or against, but
Good job.
the Microns of the world, the tech sectors that have done really strong, they're making money hand over fist.
And their balance sheets aren't bad.
Their earnings estimates are accelerating.
So this is well said, and this is the piece that Mike posted. It shows, and the data, I'll start with the dot-com bubble of the 90s. The data set for this he's referencing is from 1993 through 1999. In that time, U.S. technology stocks had an aggregate return of 1,097%. Okay? And then he shows to the right 2019 through June 30th of this year for U.S. technology stocks, up 569%. Okay? So here's what's happening right now. You got all these headlines with people like Warren Buffett. Okay? I'm not trying to throw shade towards Warren Buffett, but let's face reality. Tech stocks are not his bailiwick. He's not going out there and investing in them. Okay?
Yep.
So at the end of the day, to sit there and try to get advice on that portion of the market,
It's not his
you're not going to the right
expertise.
person.
No. He's been value. He buys companies that are very cheap.
Very cheap. It's just not. It's not his investing style.
Sure.
So when you look at the analogy, when you look at balance sheets, earnings, and you even look at where we're at in the cycle in comparison, I'm not there. And so I just want to throw it out there that you're getting a lot of analogies. It doesn't mean that in the late 90s, it was a rocky road.
Absolutely.
In 98, during the Asian financial crisis, hit a currency crisis, American stocks intra-year hit a bear market.
Sure.
No one talks about that. And of course, everyone comes across that they had diamond hands that they held all the time from 93, 95, all the way to 00, and that is not accurate.
No, not at all. It is interesting that from this chart here, there is no full year where the year was actually down for the year. What we see in 2022, we did have an actual bear market where it finished down. I believe what you
Good
say,
point.
where there's the intra year, but it finished up higher.
Good
So
point.
that's interesting. So it's not been, really not nearly as strong. Only half of what the dot-com bubble has done on a percentage performance. So who knows?
Great observation, and I'm going to say it one more time because I want to hit this home. I got the peanut gallery in the back of the podcast, right, throwing shade. We got to realize that when you are investing in stocks, there will be volatility.
Absolutely.
When you're investing in technology stocks, there will
It's gonna
be volatility.
More volatility, I would argue.
So this is
right?
how the narrative will be in the market. At some point over the next, say, quarter or two, you have a correction in the market, and it will disproportionately hit tech stocks.
Sure.
So what's the narrative that you're going to see in the main news headlines?
Is this the bubble?
There you
Are
go.
we here?
There
Right?
you go. So my next piece blends very well with this, Aaron.
Perfect.
This is a piece from the Kobayashi letter. The timestamp on this is July 9th. This is what the piece is talking about. Corporate insiders are buying tech stocks at a record pace. Huh.
Interesting.
Isn't that interesting?
Can't imagine why they do that.
I can't imagine why they would do that. 28 executives, I'm now going to read verbatim.
Perfect.
28 executives at companies within the U.S. technology sector, ETF, XLK, not a recommendation for or against, have purchased their own stock on the open market over the last 6 months, the highest count on record, according to Sentiment Trader. This figure has doubled since the start of 2026. This also surpasses the previous record of 25 insiders set in 2011. By comparison, in early 2025, just 5 executives were buyers. U.S. executives are rushing to buy tech stocks. The illustration chart will be in our show notes. I feel like I've hit this hard enough, but I just want to throw it out there that insiders are not going to sit there and buy their own stock if they didn't feel they were going to make money. If they doesn't guarantee it's going to happen.
No, but they're not going to buy if they feel it's super expensive.
Well,
or
throw it
those
out
PE
there.
ratios are unreasonable. Right?
If Mark McEvily were here, he would say something along the lines of, Matt, that's not bearish.
It's not.
He would
It
sit
is
there
not
and say
bearish.
there could be, countless reasons why someone would sell their company stock.
Yeah. You
right?
need liquidity or, your an
asset
exit
concentration.
strategy.
There's a lot of reasons.
There's only one reason to buy it.
There's only one reason to buy it.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
Aaron, over to you.
Awesome. All right. I've got my first piece here, and this is going to be S&P 500 earnings estimates. I also have it's from Charlie Bilello in Creative Planning, as this chart's here. I'm going to read the X post here. S&P 500 earnings are now expected to increase by 24% this year.
24%.
In a normal year, what we see earnings estimates are revised down.
Yeah, if we got to low double digits, I would be very happy.
Yeah, and that's what the normal years have been, is, low double digits, the 10, 13, 14,
I'd be very happy with
15%,
that.
right?
And we started off the year with an estimate of 13.2. I have it memorized.
Yes, which is very normal. So we've never seen earnings growth this high outside of a post-recessionary rebound. An unprecedented boom fueled by massive EPS gains in big tech. So, the last year that we saw growth like this was coming out off of COVID in 2020, right?
Bounce back.
So, I think this just goes to show, especially with the bubble concerns and all the talks around that, earnings are so strong in these subset of asset classes that I feel comfortable saying that they're not overpriced, and it's reasonable with how much growth they've had in earnings.
Another way to say it is, if you look at this earnings growth, this is a rare year where earnings growth has outpaced S&P 500 price appreciation.
Absolutely.
That hasn't happened many times in my career.
I've never seen it.
And that is a narrative that is getting lost in the shuffle. Secondly, if these earnings continue at this pace, just kind of stay where they're at, even fall back to 18%. Let's just throw that out there. Any dip in this market, I think, is going to be short-lived.
Quickly bought. Yeah.
And I said it, and Jenna could probably timestamp it. I said it in the podcast a month or two ago when we had a little bit of weakness.
And the narrative hasn't changed.
You're going to get some. The thing is, if you're under allocated to equities, I really feel volatility will continue. You're going to get your shots up at bat.
Absolutely. Yeah, volatility.
Don't chase it. You'll get your chances.
It's honestly welcomed at this point. With how strong the market's been, any of those dips, in my world, I would be a buyer.
I would too. I would too. You'll get your chances. Don't chase it.
Yep, absolutely. And we will have that chart in the show notes. It's a good chart by Charlie in Creative Planning. All right.
Good piece, Aaron.
Yeah, it's a good one. Next piece is gonna fit right in with interest rates. So I've got an X post by CME Group themselves. So the Chicago Mercantile Exchange reports on futures.
Yep.
And their X post here is #FedWatch. July rate hike probabilities continue to hover around 34%. This is as of July 13th, so just a few days ago. This was prior to the CPI report coming out, though. I will preface that.
Yep.
With all eyes on CPI, PPI, and Fed speak. So again, sitting in that target range of 3.75 to 400 at 34%, and the current rate is 3.5 to 3.75% in Fed funds rate. So,
and this is a good piece to highlight, because this is where the numbers were before the data came in that you articulated.
Decent shot, 1/3 shot that the Fed was going to hike rates this month. I think if we look today,
it's gone.
It's gone. It's probably next to zero.
It's gone.
So,
it's gone. In fact, the probability of a singular rate cut at some point in the second half of 2026 is now being priced in on those CME futures.
One rate
cut.
Interesting. So we shall see.
Interesting.
If inflation continues to come in lighter than expected, I don't see a rate hike at all.
Yeah,
personally.
I'll take it one step further. I don't care what party has power on the presidential side of the equation. either party would want inflation to come in and things to look rosy around the
Absolutely.
midterms. So here's the
Absolutely.
fact. You have an administration that is motivated to make decisions to try to get inflation down as much as they can.
And to basically wrap up this Iran conflict prior to November elections, right?
Yeah.
Because that's the kicker here that's causing it to stick around.
Yeah.
Is oil prices,
That's right.
essentially, right? All right, I got one more.
What do you got?
This is I also have. We had similar data pieces here.
Oh, yeah?
The Kobayashi letter on July 12th. It's an update on free cash flow stats on semiconductors.
Ooh, I've seen
This
something
is
like this.
juicy.
Very.
So I'll just read through this first couple lines here. NVIDIA, Micron, Broadcom, AMAT, Applied Materials are now expected to generate a record $430 billion in combined free cash flow over the next 12 months. I'm going to read that again. $430 billion in combined free cash
These
flow.
companies have printing presses, man.
Literally just printing money. It's insane. So again, not a recommendation for or against any of these names, but that kind of cash flow is just insane. And if you look at the chart here, this is from Bank of America Global Research that we'll have on the show notes as well. It overlays semiconductor companies, free cash flow, and hyperscalers. So all the AI build-out companies, right? So the hyperscalers are spending trillions, right, almost, over the next year or so.
Yep.
And where is all that cash flowing to? It's flowing to all these semiconductor names that are the benefactor
You're not wrong.
of build-outs for chips.
You're not wrong. Why
RAM.
don't you name some of the hyperscalers so our listeners understand who's building them?
Yeah,
Who's
so
building these data
hyperscalers
centers?
would be Amazon, Google, Meta, Microsoft, Oracle, just to name a few. So those are the companies that are making massive investments in AI and data centers, and we're seeing, the NVIDIAs, the Microns, the Broadcoms of the world are the benefactors right now.
Yeah.
And I don't know if you know this stat, how long their order flows go out for. It has to be years of backlog at this point.
Years. My immediate thought when I see this is I feel that the market or investors in the chip names, you mentioned a couple, again, not a recommendation for or against, like the NVIDIAs and Microns and Broadcoms of the world. We got to realize that, in my opinion, those stocks are pricing in how long these growth rates and these excess profit margins and excess profits are going to continue.
Sure.
Is that going to be another 2 quarters or is that going to be another 12 quarters? And that is the game that you have to play on that end, because once the growth rates start to slow, the stock prices will adjust for the new growth rate. Whereas on the hyperscalers, as they do this infrastructure build out, and when they start to slow their spending because the infrastructure has been built
out,
and they can start to enjoy the dividends.
Right, they're actually going to start earning money from all these capex and investments, right?
I just want to throw
Could
it
be a
out
good
there.
shift in some of those the hyperscaler names over the next couple of years.
Heck yeah. I mean, at the end of this decade, if you start to have the infrastructure built out and then all of a sudden the hyperscalers are the ones collecting the dividends at that point, what do you think could happen to the valuations? Potentially. I'm speculating.
Yep.
And I just want to throw a warning out to people who are drastically overweight on the chip side, who just think I can hold this for the next 5 or 10 years.
There's a risk.
There's potential bull cases people are throwing out.
Sure.
Things like the refresh cycle. How long does an NVIDIA GPU unit last when it's working 24/7, 365?
Sure.
Or what is going to be the need for memory of robotics? I've heard the other side of it. I've also been doing this long enough to know once those growth rates slow, you're going to get nailed.
Absolutely. What I forgot to mention, I like this line here. So when we're talking about NVIDIA, Micron, Broadcom, AMAT on their free cash flow of $430 billion, it says that would be more than triple the free cash flow they generated just 2 years ago. Triple. So you wonder why Micron's stock price has tripled.
Yeah, I mean,
I don't anymore.
Well, yeah, I mean, I'll pick on Micron again, strongly emphasizing this, not a recommendation for or against.
Not at all.
You got to face reality. This is a name that if it doesn't move at least 5 to 6% in a day, I'm surprised.
Absolutely.
So when I look at my system and it's up 8%, down 10 the next day, that's par for the course.
Mm-hmm.
And, if I had clients that had money in a name like that, it doesn't matter that it's Micron, but a name that moves like that.
Sure.
if they've owned it for, 5 years and I'm playing with house money, that's a different perspective I have. If I'm allocating brand new client money to a name like that, I don't know how well I'd sleep at night.
I'd be hesitant, personally.
Does that make sense?
Yeah. Small weightings, potentially.
Hey, that's why Mark McEvily gets to make those day-to-day buy and sell decisions
stress,
and be
right?
chained to his terminal, right?
That is right. I don't envy that.
Any other thoughts before I politely step aside for the one and only Taylor Ledbetter?
No, I think I like the diversification piece you started with. I think that's really important for clients that maybe, or listeners that manage money themselves, or the DIYers out in the world. It's important to diversify. Don't be chained to a handful of names that maybe have done really well. You can see the opportunity cost out there for being under diversified.
Good point. 2 thoughts came to mind when you were replying there. First is, there's a lot of those Mag 7 names that have just gotten absolutely nailed, and some just right outside the top 7 by market cap. And I'll throw out a couple. You have names like, Microsoft and Oracle. I'm not recommending them. They can keep going down. But some of these stocks
They're
are
pretty cheap.
They're in bear market territory.
They're kind of cheap.
Okay. They're off over 20%. And so there's some opportunities out there if you're a long-term investor. You got to do your homework on these names.
Absolutely.
Right? The other thing I throw out there is we're in earnings season. So earnings season is going to be for the second quarter of this year. It's where publicly traded companies are going to report their earnings and provide, most of them, guidance for the rest of the year.
Yep.
And you are going to see some volatility after these companies report. Okay.
Absolutely.
So, for example, a big name in the S&P reported this morning, United Health. They beat earnings. When I woke up this morning, that stock was already on the move. You're going to see, if you look beyond the microns and the NVIDIAs, if you see a move of mid-single digits upwards of double digits, it's probably because the market's reacting
to its earnings report.
Report.
Yeah, I'd argue that the next month or two here could be some of the most volatile periods of time that we'll go through this year.
Well said. Yeah. Right, because we're going to be on the edge of that midterm election. We got the earnings results. We still have continued geopolitical headlines you mentioned in the Middle East.
I think volatility is to be expected.
Yeah, and just we got to remember, volatility is normal. Invest for your time horizon, your goals and objectives.
Absolutely. Love it.
All right, I'm going to have Taylor on.
Awesome. Thank you. All right, welcome, Taylor.
Yeah, it's good to be back. It's been a little bit.
Absolutely. All right, do you want to jump right into your financial planning topic of the week?
Yeah, so today I'm going to be talking about just an update on Trump accounts because they were just activated on July 4th.
Perfect.
So I know Mark did talk a little bit about this topic on last week's podcast, so I won't do a ton of reiteration, but just as a reminder, Trump accounts are essentially like an IRA for kids.
Yep.
Almost.
Exactly.
And previously, so we all kind of knew that the government was going to do matching contributions of $1,000. That was for kids born between January 1st, 2025 and December 31st, 2028.
Okay.
But some new matching contributions have recently come out. So now, if you were born before January 1st, 2025, you're actually eligible to receive a one-time deposit of $250.
Excellent. And when you say matching contributions, does that mean that the parents or someone would have to put money in, or do they just have to apply for that $250?
Yeah, actually, that's a good catch. So the parents or whoever's contributing doesn't have to put money in.
Okay,
so just
that's great.
Regular
That's awesome.
contributions, I should say.
Excellent.
So to be eligible for that $250, you have to be 10 years old or younger when the program launched. You have to have a valid social security number, and you have to live within a zip code where the median family income was $150,000 or less.
Okay. Interesting.
And I do think it's possible we could see some more of these like one-off extra contributions, because the reason this $250 was introduced is actually because of Michael and Susan Dell of Dell Technologies.
And their foundation?
Yeah, so they
Awesome.
made a massive donation, and I believe other companies are interested in doing the same thing.
Okay.
Just nothing's been confirmed
Yeah,
yet.
I know this is also new. Nothing's really formalized or finalized at this point quite yet.
Right. I mean, yeah, the account has been activated for like
Like,
2 weeks.
Yeah,
if that.
exactly. Perfect.
I think there was also some questions about the investment side of things for this account. So as of right now, any contributions made to the Trump account are going to be kind of put into a default investment.
Okay.
So the default investment for right now, it's called the State Street Spider Portfolio S&P 500 ETF. Kind of
Okay.
a mouthful to say.
It is a long one.
So essentially, this is just going to be tracking the S&P
Yep.
500. So it's going to be all stock. The Treasury is going to make other investment options available. We
Okay.
don't know when. So for right now, this is the only
That's the only option. Yeah, my guess is they'll have other kind of broad market indexes that are available. That would be my guess. Similar to the SPY or SPYM, will likely be maybe some more broad market that extends outside of just the S&P 500 would be my guess. Who knows though?
Yeah, no, I think they do kind of have a working list of 5 to 6 other ETF options, like international or total market index
Gotcha.
options.
Perfect.
So they all have to be low fee as well, hence why they're going the ETF route.
Excellent.
So I also wanted to go over how to actually open up this account. And you can do that a couple of different ways. So you do have to file Form 4547. So to do this, you could have made that election on your 2025 tax return.
Okay.
If you did not do that, you are able to submit this form in the Trump Accounts app. And the Trump Accounts app is live on the App Store, so you can go ahead and download that. But the other option is you can just create an account on the IRS's website, and you should be able to fill out and submit the form
Excellent.
on there. And as far as the app goes, so again, that's in the App Store. It's also in Google Play. It's just called Trump Accounts.
Trump Accounts. Awesome. Easy.
I think it has like a white and gold picture on it.
Perfect.
So when you have activated the account and you're all signed in, you'll be able to see all of your balances, contributions, investment performance. You'll be able to set up recurring contributions and link your bank account
Excellent.
as well. And something else that I thought was really cool is they do have financial education modules for the parents and the kids.
That's wonderful. I think that's a great thing because I mean, there's so many. You don't get a lot of financial education typically in school. I know there's a big push across the U.S. to get that in schools, and it's becoming more popular. But having an easy to access resource with good information is important, and hopefully helps motivate kids and parents to invest long term because we all see every day like the benefits of long term consistent investing, but not everyone has that opportunity, right?
Right. Yeah, it's something that they can just sit down and kind of watch together.
Awesome.
As of right now, I think there's about 15 different modules
Perfect.
on there. So I would think maybe over time they would add more. I'm not sure if it's just like 15 videos or 15 lessons that are more interactive, but either way, I think it's great that they have that on the app.
Love it. Love it. Love it.
But yeah, as far as new information, it was really those investments and that contribution I wanted to touch on. I think that kind of answered a little bit
of the unknowns.
questions.
Perfect. Yeah, I
Yeah.
think that's great. I think we'll obviously have the stuff in the show notes, so you can use the links here to get access to that, and I think it's something everyone should take advantage of, right? Some free money and jumpstart your child's kind of retirement or savings, and investments, right?
Yep, I completely agree.
Perfect. Anything else on the Trump accounts for listeners?
Nope, I don't think so.
Perfect. All right. Well, I appreciate that. That is useful information for listeners. We'll sign off at this time. Thank you for listening to episode 359 of the Independent Advisors Podcast. Catch us next week on episode 360.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.